Welcome back to our channel. In the last video of the derivative series, we saw the real-life similarities to an options contract with an example and understood the basic concept of options. But hold on, the things we discussed in the last video was just a tip of an iceberg. So, in this video, let us dive deeper and understand the concepts of technicalities of options. Options are a type of derivative products that allow the trader to speculate or an investor to hedge its position against the volatility of an underlying asset. There are two types of options, a call option and a put option. Call options allows the buyer to profit if the price of the underlying asset increases, where the put options are the opposite to it. Put options allow put option buyers to profit if the prices of the underlying asset declines. Investors can also short the call and put options. Shorting or short selling is a trading strategy wherein traders sell the stock first, ideally at the higher price, and later buy the same quantity of stocks after the significant fall in the stock prices. The difference between the margin of high selling and low buying becomes the profit of the trader. In options, shorting is also termed as writing, call option writing and put option writing. When a trader writes a call option, he has a bearish view, and when he writes a put option, he has a bullish view. So, shorting or writing is exactly opposite of buying or taking a long position. This table will help you understand what is option buying and what is options writing better. If a trader has a bullish view, he can either buy a call option or sell a put option. Similarly, if he has a bearish view, he can either buy a put option or sell a call option. Traders and investors buy and sell options for several reasons. Option speculation allows a trader to hold a leveraged position in an asset at the lower cost than buying a share of the asset. Investors use option to hedge or to reduce the risk of exposure of their portfolio. For example, if an investor is holding 5,000 shares of Reliance, and if he thinks that in the coming week the share prices will drop by 2%, then the investor can buy the same units of put option at the strike price closer to the current share price. Now, even if the Reliance share falls, the investor will make profit in the put options. The loss in the equity and the profit in the put options will nullify each other, thereby hedging the investor's portfolio. It would be best to buy a put option by matching the delta closer to 1. We will explain about the Greeks in the coming videos of our channel. For now, let us show you the options chain of Nifty index and explain you the different concept of options. On the screen, we can see the call option chain on the left side and the put option chain on the right side. At the center, the strike price is noted. Strike price is a set price at which an options contract can be bought or sold when it is exercised. For call option, the strike price is where the security can be bought by the options holder. For put options, the strike price is the price at which the security can be sold at the time of the settlement. The options contract has an expiry date on which the options contract are exercised and settled. There are two option standards followed across the globe: American options and European options. American options give the option holder the right to exercise option at any date before the expiration date. Whereas in the European options, the options holder has the right to exercise the options only at a pre-agreed future date, that is the expiry date, and a pre-agreed price. In India, we have weekly, a monthly, and a multi-monthly expiry for the options. Every Thursday of the week is the expiry day for the weekly options contract, and for the monthly options contract, the last Thursday of the month is the expiry. For the January month, we can see that the expiry day is 27 January 2022, which is the last Thursday of the month, and since now it's the last week of January, the weekly expiry day is also the same. Currently, as we can see, the cash market of Nifty is at 17,617.15. Since the strike price 17,600 is closer to 17,617, the strike price 17,600 is at the money. For the call options chain, all the strike prices above 17,600 is out of the money, and all the strike prices below 17,600 is in the money. For the put options, this is exactly opposite. All the strike prices above 17,600 is in the money, and all the strike prices below 17,600 is out of the money. When a person buys a put option, say Nifty 17,600 PE, he expects the market to stay below 17,600 till the expiry, and if it stays below the 17,600, option buyer profits, provided the move towards the downward side is large enough and the theta decay is not much. Theta decay is nothing but time decay. As the expiry day comes closer, the value of theta increases, since the time left for the expiry is reduced. The time decay component of the premium price at the time of the expiry goes down to 0. All the digits shown under the call option chain and the put option chain are called premium of the options. An option premium is the current market price of an options contract for a particular strike price. Just like how insurance company works, the insurance company collects a small amount of money called as premium from the insured individuals who buy the insurance policies. If no claim comes that year, the premium amount becomes the profit of the insurance company. And if there's a claim, the company has to pay the insured person the insured claim amount, and the company has to book the loss. Similarly, here, the options buyer pays the premium to the option seller. Option seller collects the premium and, just like the insurance company, insures the option buyer against the volatility. If the underlying asset price does not cross the strike price on the upward side in case of call writing and downward side in case of put writing, the option seller makes the maximum profit of the total premium amount received by the option seller. But if the underlying asset price crosses the strike price, the option seller can lose a massive amount. For an option seller, ideally the risk is unlimited. The loss to an option seller is a profit to an option buyer. Futures and options is a zero-sum game. Profit to one party is a loss to another counterparty. Option premium is a simulation of two values, intrinsic and extrinsic value. Intrinsic value is the difference between the market price and the strike price. Let's take an example of Nifty options of 27 January 2022 expiry. Here, the market price is 17,617.15. If a trader buys a call option at a strike price of 17,500 for a premium of 199.95, then for the premium price, how much will be the intrinsic and extrinsic value? Let's find out. Here, the strike price is 17,500. The market price is 17,617. So, if we subtract 17,617.15 with 17,500, we get 117.15. This is the intrinsic value of the premium. The additional premium value is the time value component known as the extrinsic value. The trader bought call option at 199.95 premium. So, the time value is premium price minus the intrinsic value, which is 82.8. For out of the money contracts, the option premium will consist only of the extrinsic value or the time value. The intrinsic component is 0 for the out of the money contracts. In the money options contract consists both of intrinsic and extrinsic value. At the time of expiry, the time value, irrespective of in the money or out of the money options, will go to 0. If you have liked the video, do give it a like, share and subscribe for more knowledge about the financial world. And also you can follow us on other social media platforms. AdiTej Fin Serv signing off.